Hi, everybody. Very good morning to you all. Once again, apologies for starting a minute or so late. We had a slight slide issue, which we've now thankfully resolved. So good morning to you all, and thank you very much for joining us this morning. Welcome back to the K3 Hub. This is our first session since the summer break, and I'm really pleased that you'll be able to join us this morning. We've a couple of speakers this morning who I will introduce in order, but in the meantime, a few introductions. So my name's Marie Wadeson. I'm a Managing Director at the K3 Capital Group, and I lead the K3 Hub, which is a member network for professional advisors developed by a number of brands within our group. I think most of us have met previously, so I'm going to skip some of the usual things that I tell you at this point in my introduction. And instead, I thought I might just share a few things that we've been up to over the summer months. So firstly, you will see that there will be a poll appear on your screens any second now. We are in the process of preparing our new and improved webinar program for 2026, and we're really keen to get your input into that. So if you would do me the honor of letting us know the types of subject matter that you're interested in, and so on and so forth, that would be really, really helpful for us. We're obviously here to add value to you, and we do want your input. Secondly, for a second year in a row, I have got some itchy feet. Quite keen to see if there's any appetite for some perhaps smaller in-person seminars out in the regions, and/or some social or networking events which we could schedule into the program. Again, if you could let us know if you've got an interest in doing that, which would sit alongside the Friday morning webinars, which you told me that you enjoy so much this time last year, then I would be grateful. So on to a few things that have gone on over the summer. So for those who do regularly attend the webinars and have got razor sharp hearing, you might have noted at the top of the webinar that I said that I'm a managing director at the K3 Capital Group. Before the summer, I would have said that I'm a managing director at Quantuma, which is one of the brands within the K3 Capital Group. I'm pleased to say that my team and I have moved into the K3 group now, and we work right away across the group. So we've been busy getting familiar with the majority of our 20 plus brands that we now have in the group. So that's been an exciting time. We've been lucky enough to agree with the K3 leadership that the K3 Hub should be in for a significant revamp. We'll be working hard in the coming months to provide or to improve even the value that we provide for you. We expect the new and improved K3 Hub to come into its own in early 2026. Over the summer, the group secured its latest acquisition, this time a wealth management and asset management business in Manchester called Pareto Wealth Management, who some of you may be aware of. We're busy integrating them into the group as it stands. Wealth management division sits really neatly alongside our existing business units, which include business sales, corporate finance, restructuring, tax, and technology solutions. And I'm looking forward to seeing what comes for everybody in the year ahead. If anybody, and finally, just a quick note from me, if anybody happens to be in the Northwest and attending Accountex in Manchester next week, I will be there with my K3 colleagues from one of our R&D tax credits businesses, Rand UK. If you're going to be there, please do pop over. I'd love to see you. Right, so enough about what we've been up to, and on to a few pieces of housekeeping before I introduce you to the first of our two speakers. So you'll note that we are recording the session today. It will be placed onto the K3 Hub website next week. Q&A function is open. I am going to chair the Q&A sessions today. I'm going to do a short Q&A after our first speaker and a second short Q&A after our second speaker. I'd be really grateful just to help me out if you could put your questions into the Q&A rather than the chat, just so I've got everything in the same place. That'll really help me out. Now, we have had some questions in advance of the webinar. So if we don't make it through all of your questions, then I'll apologise in advance. What I'll do instead is I'll pass those outstanding questions to the relevant speaker, who will come back to you following the webinar. We are sharing the slides in the chat, and if we haven't done it already, they'll appear shortly, and I expect the team in the background will post them a couple of times just in case we get some latecomers. Again, just a reminder, I think the poll is going to stay on the screen to give you time to respond, and I'd be most grateful if you could get involved. So moving on to our first speaker. So I'm very pleased to be able to introduce you to my Quantuma colleague, Richard Easterby. Richard is a licensed insolvency practitioner at Quantuma and is also the head of the Birmingham office. He has more than 15 years experience advising company directors, secured lenders and other key stakeholders across a variety of distress situations. He's worked on a really wide range of corporate insolvency assignments of both a transactional and a complex nature. And amongst those, I'm sure he'd be including the Derby County Administration from a couple of years back, probably right at the top of his list. Richard, welcome back to the Catering Hub, and over to you.
Thanks very much, Marie. Hello, everyone. So I'm going to start just by rattling through the agenda and the items that I'm going to cover, and then I'm going to talk about them. So yeah, firstly, the current economic environment. Then we're going to look at how the current formal insolvency statistics and the numbers are driven by that. A few market observations, so what I'm seeing at the moment, and the activity in the local market over the last few months. I'm going to touch on the decline curve, which many of you will be familiar with, so I'm not going to dwell on that. But then we'll look at the warning signs, particularly around companies entering into distress. And finally, just a few ideas about what we think is going to impact future business and financial performance. So, first of all, the current economic environment. The UK is a bit stuck in terms of its productivity growth and has been for a long time. Now, a lot of politicians will be talking about economic growth and how key that is to the success of the economy, in the success of enterprise, and the available amount of investment in the UK. So what is productivity? It's effectively the amount of output that is achieved from a given level of input. It's really the efficiency at which an economy operates. So what is causing the productivity malaise? Firstly, I don't want to get too political about Brexit, but it is undeniable that Brexit has put in place trade barriers. It has led to extra red tape and bureaucracy around doing business with the EU. As a result, that's led to certain players leaving the market and others failing within the UK market. Now, from an economic kind of theoretical point of view, a reduction in competition leads to less requirement for innovation and investment. There's less availability for investment. That's compounded by the government finances. The cost of government debt is very high, and therefore the availability of taxation money to invest in the UK economy is low. There's international uncertainty, whether that be Ukraine or Gaza conflicts, or the tariffs that Mr. President has been imposing from the White House. Markets don't like uncertainty; they like predictability. And if a country doesn't know whether they're going to have tariffs at all, or whether they're going to be consistently applied, is it going to be 10%? Is it going to be 25%? Is it going to change next week? It's causing uncertainty in the market and panic throughout the economy. High energy prices continue to impact business, as does high inflation. Now, high inflation generally, which is partially driven by the energy prices, it's not at historical high levels, but it is quite sticky. So again, yesterday, the Bank of England Monetary Policy Committee kept interest rates at 4% because of the persistent inflation over and above their target levels. The after effects of the pandemic are still being felt. So whether that's in the likes of COVID debt still appearing on many company balance sheets, or whether it's a change in consumer habits. So I'm working from home today. There's still a working from home culture, whilst things are creeping back to what they were pre-pandemic. Are they ever going to get back to thriving city centre and town centre economies? There's a big question mark around that. There's an aging population, so that means that a higher proportion of the population is out of work, and that puts extra pressure on the working population. So a smaller proportion of people having to generate the funds and the capital to look after the entire population. And finally, fiscal drag. So whilst wage inflation has actually been not too bad, with the tax threshold staying the same, more and more people are getting pulled into higher tax thresholds, and therefore it's having an impact on available and disposable income. So now we'll have a look at the formal insolvency statistics. This first graph, it's taken from the government website, and it goes back to July 2020, which is broadly the end of lockdown number 1 in the pandemic. And you can see that at that point, corporate insolvency numbers, which is the top line, total corporate insolvency numbers, they were relatively low. We know there were lots of government interventions, whether that was furlough or COVID loans. But over the last couple of years, that has really crept up. In terms of the breakdown of those corporate insolvencies, in the year to July 2025, there was a total of 2,081 formal insolvency appointments. That was similar to the previous month, and it was also similar to the same month, so July in 2024, the previous year. We are slightly down on some of the months in 2023, but those were historical high numbers. There's 30-year highs in 2023 in terms of monthly insolvency appointments or yearly insolvency appointments. So what makes up the 2,081 formal insolvency appointments? It's largely driven by creditors' voluntary liquidations. About 3/4 of the appointments are CVLs. So what's a CVL? A CVL is a voluntary liquidation, as it suggests. It's director-led, but most liquidations result in businesses closing down. Not all, but that's generally what the processes are designed for. But as I say, the majority of appointments continue to be director-led. One thing I did want to point out, though, is that an orangey line towards the bottom, compulsory liquidations. That is creeping up. Now, compulsory liquidations are usually creditor-led, so a petition for a company to be wound up by an individual or entity that is owed money. As a rule of thumb, about 50% of compulsory liquidations and winding up petitions are initiated by HMRC. So does that suggest that HMRC are taking a bit more action now? We'll have a look at that a bit later on. So if we could move on to the next slide now. Now this is quite a scruffy graph, so apologies for this, but this looks at the insolvency numbers over a longer period of time. And what this demonstrates is, if you just concentrate on the top line, the total insolvency numbers, historically, this is pretty high now. We are looking at levels that we've only really seen before, or certainly since the turn of the millennium. We've only really seen them during the credit crunch or in the immediate aftermath of the credit crunch. There are a couple of individual peaks here which you can kind of discount. So for particular unusual situations, on a single day in 2006, in November 2006, and another day in October 2008, that you can see that there are spikes in the numbers, and that was just due to a large number of connected entities that were put into administration on those two individual days, so they can be discounted. So as we can see, the general trend is that overall insolvency numbers are pretty high at present. As a proportion of total registered companies, in the year to July 2025, there were 52.5 companies out of every 10,000 registered that went into formal insolvency in that year. That's slightly down from the previous year. Now, the rate is considerably lower than it was in 2008-09 during the credit crunch, when it was up at 113. companies out of every 10,000. However, in that period, the number of overall registered companies has more than doubled. So whilst the rate has halved, the number of overall registered companies has doubled, and the impact is that the overall company insolvencies are broadly the same as they were back in 08, 09. So now if we move on to have a look at what I have been seeing. So I'm based in the Midlands. Just to give you a bit of context, there are some fairly major things happening in the region at the moment. But these are the sorts of things that are coming across my desk. I've listed here the industries that we've been advising at the moment, or companies within these industries. So all of these listed, we've been advising in the last 2 or 3 months. So property businesses, hospitality, financial services, automotive, construction, and education. I'd also add manufacturing onto that, and there's others besides. So we touched upon HMRC earlier, and I want to revisit it because we can see that it appears that HMRC are flexing their muscles a bit more in terms of winding companies up. However, what we're also seeing that we haven't necessarily seen before is a really accommodating and conciliatory approach from HMRC if you engage early with them. So we've seen several instances now where clients have failed time to pay agreements, and HMRC have agreed second time to pay agreements with them. Now, that's not something that we've seen historically, but it does show that they are understanding of the situation, and with the right communication and information, they can be prepared to be fairly flexible. Personal guarantees are something that's cropping up all the time now. There's a big change has been a big change in the lending landscape over the last 10 or 15 years. But many companies that approach us, their directors have provided personal guarantees for their debts, and that can impact on the appetite of directors and the motivations of directors in how they move forward with the advice that they receive. A key recent development has been high-profile cyber attacks. So Jaguar Land Rover locally is going to have an absolutely huge impact on the local economy. There's a huge amount of businesses in the West Midlands in particular that are reliant on JLR and are part of the supply chain. And I think it's been suggested this week that normality won't return until perhaps November. So there's a lot of discussions, a lot of head scratching at the moment about whether government will step in to support the supply chain, and how those businesses are going to get through that time, and indeed if they can get through that time until JLR's back up on its feet, and also what the medium to long term looks like for those businesses. COVID debt, I touched upon the fact that we're still feeling the after effects of the pandemic. Almost every company that we advise still has COVID debt on the balance sheet, and that is an extra level of cost that they could do without now in a struggling market. However, it needs to be repaid. Discretionary spend. Now, hospitality is always a big business for us in good times and bad. However, the cost of living crisis has really impacted on discretionary spend. We're seeing it a lot whereby anything where it's a B2C model, individuals are struggling to find that extra money to go out and spend on things that they want, whether that's a meal out or a treat from a retailer. Debtor days and late payments. This is increasingly problematic in supply chains. You do hear about some of the larger customers dictating how quickly they pay, and it can have a real impact on the ability of smaller suppliers to pay their bills, pay their payroll, etc., etc. So now we'll have a look at the decline curve just quickly. As I say, this is something that you are probably familiar with, so I'll just rattle through this But the decline curve effectively shows the journey of a business once it starts to experience trouble, and where it either survives or fails. So we can see that going from stage one of the growth phase into underperformance and then distress, and the inflection point is around crisis, whereby a company either successfully enters into crisis management, stabilization and recovery, or it fails and falls into formal insolvency. Now, we would tend to be involved around the distress or even crisis stage, and the options that are available to a business are significantly more the earlier that we get involved. Often we're approached by a director saying, payroll's due in 2 days, what can I do? And obviously in that situation, options might be pretty limited. Whereas if we're approached a few months before, the situation changes fairly substantially, both in terms of options, but also outcomes. So now the warning signs that we see in terms of a business that is facing distress. So we can move on to the next slide. The first one, fairly obviously, is cash flow, pressures on cash flow. What are the pinch points? What is the reliability of the information? So this could be a company that you work for, that you're a director of, or it could be a company that you advise or that you have dealings with. What's the reliability of the information that you're provided with? Where do the risks lie? What are the certainties around the causes of the cash flow squeezes, and the instances where the company looks like it's going to run out of cash? Creditor pressure. Now, just like if you don't pay your bills at home and you get red letters through the door, there are some fairly obvious signs of creditor pressure. Again, red letters, emails, suppliers turning up on the doorstep, and key creditors like landlords looking to enforce terms of leases. HMRC are a huge creditor in insolvency situations. Now, they are somewhat of a faceless creditor. They're not someone that businesses have day-to-day dealings with. They don't have a point of contact that you have a rapport with necessarily. And they're not required for immediate deliveries. So if a supplier is jumping up and down about being paid so that you can receive a delivery tomorrow that's required for ongoing trade and ongoing operations, that's not the position with HMRC. So often in distress situations, the HMRC debt is allowed to rise. So if you see a company with a large or abnormal HMRC debt, it is a red flag. The cost of debt and access to debt. Now, as a company's performance diminishes and lending to it becomes riskier, then the access to lenders reduces, but also the cost of that debt reduces. So the types and cost of borrowing is an indicator of a company's financial situation. If a company loses a key customer, or if a strong competitor moves in, then that is something that can have a strong impact on ongoing success. We see this a lot in hospitality, whereby if you're not the cool venue at a given time because a new one's opened up, and then that can have a real impact on your business performance. Squeezed margins are impacting companies across the board, and that is it impacts both sides of things. So costs are very high at the moment, whether that's energy or material costs or labor costs, but also it's difficult to pass on higher costs by way of increased prices at the moment. Acute events, so that's things like the cyber attack or perhaps a flood or a fire, and those things might not be very easy for a company to predict or even to allow for, and therefore they can have devastating effects. The quality of information that's provided is an interesting and key indicator of how a company is doing. If you're used to receiving a good quality MI and timely MI, but that starts to tail off. And perhaps for accountants, if your clients aren't dealing with the upkeep of their accounting system, that can be a sign of increasing difficulties with trading. And finally, on this slide, prevarication. So what are the excuses that are being given? Are you being fobbed off when you're chasing for payment or chasing for information? And so finally, on my last slide before the Q&A, what do we think is going to impact future business and financial performance? Well, the next key event is the budget. Budget, and particularly at present, there's a lot of noise about the next Labour budget. Companies tend to put off decisions until budget's happened. So they might have been holding back on investment. Tax rises are expected. So there's lots of companies and individuals that are sitting on their hands and waiting for that to pass before making decisions. Now, tax deadlines sometimes introduced in budgets aren't implemented until perhaps April, in which case it can actually unlock a flurry of activity. We often see business sales and exits, or in my side of things, solvent liquidations, when a looming tax deadline is known and is set. We briefly touched upon access to finance. The world of lending and finance is such a different beast than it used to be 10 or 15 years ago. Now there are so many lenders, so much choice. And we think this is a really key area where advice is invaluable. It helps customers and clients navigate both the lender market, but also help with the provision of information to lenders to be able to ensure that they obtain the best and the appropriate level of debt. Technology is key across the board. So whether that's embracing technology to make sure that a company can thrive and grow, but there's also weaknesses, whether a company is technophobic, but also vulnerable. So, we've spoken about cyber attacks before, and it's not just about embracing technology at all costs. It's doing so in the right way, so that you're not left open to cyber attacks or to data loss, for example. Construction continues to be an interesting and regular attendee in our world. Government targets are pretty punchy now, particularly around new build housing, and there's question marks about the practicality of fulfilling those targets. So yes, planning laws are apparently being relaxed, although there's I understand that successful planning applications in the last 12 months or so have been particularly low. But there's difficulties around the availability and cost of labour, similarly with materials, the availability and cost of materials, and also margins. Margins can be incredibly tight in construction. And again, this is a key area where supply chains and late payments can have massive ripple down effects. So we talked about national government funding and the availability for investment, but also at a local level. So, my local council in Birmingham is in a perilous financial position. And so the availability of local financial support for small enterprise is something that is increasingly going to be unavailable over the coming years. A simplistic one, business and consumer confidence. Generally, if businesses or individuals are confident, they will spend, they will invest, they will speculate, they might take that extra risk. Whereas if confidence is low, they're more likely to not take that plunge and to sit on their hands, to save and to stockpile. And fraud. We see fraud a lot in my world, in the insolvency world. However, when times are really hard, it does increase the occurrence of low-level fraud. So perhaps an unexpected person taking funds from a company, that can become a lot more common because things are so hard, and it is a desperate action by people who are struggling. So that's all pretty jolly stuff. So you are welcome for me uplifting you over the last 25 minutes or so. That's the end of my slides and my presentation. So I wondered if there are any questions.
Thank you very much, Richard, for the, as you say, the state of the distressed nation. As I was listening to you there, that struck me. We have got a few questions for you, so I will start as I mean to go on. So, Richard, you mentioned the warning signs to look out for. What are your tips and for, sorry, I'll start again. What are your tips for how directors should address them?
Okay, so it's key for directors to be aware of when they are facing problems, to recognise the situation early and to plan, and plan some more. There is advice available. There's plenty of help available, and so the likes of an insolvency practitioner or an accountant can help with that planning and can help with providing the options that are available. I used the example earlier of when you've got 2 days until payroll is due. There's not a great deal of levers that can be pulled in that situation. So with early advice, you can look at the borrowing options. There might be investment options, negotiation of key contract, negotiation with HMRC, as we discussed. Is there a business sale available? And you can also look at cost cutting or turnaround and restructuring possibilities. So it really does change things substantially in terms of options. And even if it results in a formal insolvency process after all of that, at least it's a much more controlled process than at the end when it's kind of panic stations and really quite rushed.
Great, thank you. The next question, so I'm going to now ask you to look into your crystal ball, if you might. How do you think HMRC's stance will change over the months ahead?
So I mentioned a couple of things with HMRC, the fact that on the one hand, they are increasing the amount of winding up petitions, it would seem, that they are issuing. Now, they would tend to be against companies that are non-compliant or non-communicative. So I think it is refreshing that they are engaging with companies and being accommodating with companies that are engaging with them early and that are providing them with sensible information. So I'd like to think that that is something that will continue. However, with HMRC, it is always difficult to tell. There can be motivations from a political point of view that perhaps it's time to take a stronger stance to collect in more tax money. But also there's difficulties with resources with HMRC. So it is difficult to tell, but I would like to think that this current position of a slightly more accommodating and conciliatory manner is here to stay, at least in the short to medium term.
Great stuff. That's really useful. Thank you, Richard. In the interest of time, I do have a couple more questions for you, but I'm just going to hold them back and pass them on to you after the session so that we can move on to our next speaker, if you will forgive me for that. So I am very pleased to be able to welcome Andy Milnes from K3 Capital Group brand HMA Tax to the webinar. Andy's making his debut today, so I'm looking forward to putting him through his paces. So by way of a quick introduction to Andy, he is a director at HMA Tax, as I've just said. He has over 30 years experience in the financial services sector and has assisted property owners to identify over 160 million in unclaimed capital allowances. He partners with accountants, lawyers, and real estate firms to help their clients maximize their tax position, utilizing underused specialist tax legislation. Andy, welcome to the K3 Hub, and over to you.
Thank you very much. Thank you. Pleasure to be here today. Yes, I just wanted to just give you a bit of an insight really into the world of capital allowances and how we can identify some hidden value within clients' commercial property. As Marie said, I'm sales director at HMA Tax. I've been with the company for over 8 years. We work with accountants, listers, property owning businesses to uncover missed savings from commercial property. So what I'm going to do is just a short and practical 20 minutes to give you an idea of some quick wins that you can take away, but also showing how working with specialists like us can help deliver more value to your clients, but without adding to your workload. So who are we and what do we do? So yeah, as a company, we've been established since 2014, so over 10 years now. We've done over 9,000 claims and have a 100% success rate with HMRC. And in terms of competitors, that probably puts us we do about 50% more than other companies in the sector. So we generated over £650 million in capital allowances, regulated by the Institute of Chartered Accountants. And we joined the K3 group last year, just over a year ago, and are very pleased to have done so. So what do we actually do? So as a company, I guess people hear of capital allowances, but are not sure how to fully maximize them. And really, the key people within our business are the surveyors. So being able to identify all the qualifying items in a property, such as heating systems, lighting, electrical systems, flooring, lifts, bathrooms, kitchens, those kind of things. Often people inherit those items when they purchase the building. And it's difficult for accountants and professional advisors to be able to put a value to that because their client didn't pay for them. They were just included within the purchase price of the property. But often they're entitled to claim capital allowances on those items, providing the previous owner hasn't claimed. So what we will do is we'll send our surveyors into the property. They'll identify, they'll photograph and value all those qualifying items in the building. We'll obviously remove from that list any items previously claimed by the client and their accountants, and then prepare the final report and submit that report to HMRC. So yeah, there's a number of different departments within the company that provide the evidence, provide all the factual items that go into those final reports. So why do capital allowances actually matter in 2025? I believe that in 2025, capital allowances still remain one of the most powerful and overlooked tax reliefs. And actually used correctly, they can cut tax bills and generate HMRC tax refunds. But there's billions that are unclaimed annually, often because the rules are complex, they're constantly changing, and obviously, a professional advisor are focusing on the more obvious allowances, but there's things that still remain untapped within this area. So looking at kind of missed opportunities, often there's gaps in potential claims, and when properties are bought, there's do we fully check whether the fixtures were fully claimed? When fit outs and refurbishments are done, sometimes the spend isn't fully analysed for allowances. There's historic spend where projects are forgotten about, even though we can actually backdate often those claims. And also there's times when landlords have funded tenant works and frequently don't realise that they can claim. And these are all opportunities to add proactive value for clients. And then when you look at, we're often called in on transactional when transactions kind of go through, whether we're acting for the buyer or whether we're acting for the seller. And there's the thing about the completion of the S198 and whether those whether that form is actually completed correctly at the time of the transaction. So when we're looking at, we can act for both parties, the buyer or the seller. So I thought it'd be useful to actually give you some kind of guidance as to when you can potentially actually seek further guidance and whether you think, oh, okay, this has been accurately completed. So it's likely to be correct. The S198 is obviously the form which transfers capital allowances or between the buyer and the seller. If it's completed and the value is more than £1 or £2, and it looks appropriate for the value of the property, then you can probably say that's probably about right. That probably doesn't need to be questioned. And I'll go into a bit more detail about the kind of percentages and what you'd like to find within different buildings. If you've got a response where an S198 is missing, or it shows not applicable, nil, zero, £0, or a £1 or a £2 value, then it potentially needs questioning. Often these things are completed where there's a £1 or £2 election. Sometimes it's strategically done because the seller wants to retain the capital allowances but doesn't want to disclose it to the buyer. But sometimes it's put down because that's what we've always done in the past, and it's never caused any issues before. But what it is doing is it could potentially have a negative impact for the buyer. So in which case, we're happy for people to contact us, and we can dig into these things a bit deeper. Where there's been no capital allowance consideration within the draft contract or the S198, and it's often include a statement to refer to accountants. Again, we can pick up on this, and we can also provide the appropriate wording for the contract to make sure that buyer's position is protected, and that there's no issues going forward once the client's completed and they want to move forward with a capital allowance claim on that property. Then if we look at the seller's point of view, so if we're acting for the seller, if the client has claimed allowances and has set values, then they've got the option to either keep the capital allowances and offset those capital allowances against the profit from the sale, or offset them against income and profit from other properties they have within the company, or you can transfer them. If often when a seller is retiring and has no further need or is able to claim any outstanding capital allowances, they can transfer them. Either they can use it as a negotiating tool, or just transfer them across at no extra cost. Again, this can be a bit unclear. So again, if there's no clarity, if there's no decisions made as to how these are going to be dealt with, by all means contact us. We can look at those the seller's position. We can see if there's a viable claim and if there's any benefit to them in proceeding with that, or if there's no viable claim, and we can provide again the wording required there. Now, looking at these kind of things, it's important really just to make sure that everything is completed correctly, and that's the key really with this. And an inaccurate S198 election can have a negative impact for the buyer going forward. So that's where we get involved, and we can actually indemnify you guys when dealing with this. This is all we do. So we have indemnity cover. So we would always give the right advice to the client, but we also give that peace of mind to say that if HMRC ever came back and queried anything, we have indemnity to actually defend that for the clients. So that's key really, and it's all about protecting the clients and making sure those capital allowances are done correctly. Looking at any kind of quick wins that we can identify. I've given you an idea here. A lot of the capital allowances are when we're looking at retrospective claims. So clients that have bought a property, they haven't made any improvements to the building. They're just looking at what within that building they've just purchased, can they potentially claim capital allowances for? Now, obviously, we come across different types of buildings, and those different buildings have different qualifying items within them. So obviously, things top of the list tends to be care homes and hotels. You think of, I always use the analogy, if you take the building and you tip it upside down, it's what remains in the building is what we're claiming for. We're not claiming for the furniture, the desks, the tables, that kind of thing. We're claiming for heating systems. We're claiming for ensuite bathrooms, commercial kitchens, flooring, any kind of smoke and fire detection systems and that kind of thing. And those are, quite prevalent within hotels and care homes, where we can often find, excuse me, 40 to 35% in those types of properties, 32% in restaurants, cafes and pubs and that kind of thing. And then the lower end of it tends to be factories, industrial units and warehouses, because obviously you've got a big building, you've got a lot of empty space, but there's things like three-phase electric, roller shutter doors, all those kind of things which could well qualify for a capital allowance claim for clients. Holiday lets I've also included in that. Now, there was a change in legislation recently, so it's holiday lets you can claim for at the moment, but only for a limited time. Likelihood is that it would have only got another year or so left of those if we can kind of backdate the claims, and as long as they've been up and running as holiday lets by April this year, as long as they're holiday lets, then we should be able to look at those. And also any kind of spending that you've done in the last 2 years. So again, we'd be looking at annual investment allowances, maximizing the claim for those. And often there's situations where clients have spent a lot of money on improvements, but the invoices from the contractor is phase one payment, phase two payment, or very little information or description about what that spend has been done. So we can often then go back and say, right, okay, well, if you spent £500,000 on improvements here, but there's not enough information there to be able to claim the capital allowances, again, we'll send in our surveyors. They'll identify where that £500,000 has been spent, document what is qualifying, what isn't qualifying, and then actually generate some real benefits for the clients. But there's often some red flags and some risks really where you can come a bit unstuck. So I just want to cover some of those really. Often we come across inconsistencies really when you're sampling expenditure across sites and there's no consistency in that information, then obviously HMRC will be all over it. They always like consistency. They always like to make sure that everything is looking correct. Record keeping is key as well. It's key for when we submit our claims. If we haven't got the evidence, if we haven't got the proof to back that expenditure or the fact that that item was in the property, then we don't claim. Again, transactional side of things. If the CPSE inquiries aren't completed correctly, then it can cause problems in the future. Incorrect wording can cost thousands, tens of thousands, hundreds of thousands of pounds of potential relief that could be generated for the property owner. And also things like overclaiming structural works as plant can also lead to problems. So it's all about proper evidence, backing up the claims, and having that kind of expertise to be able to do that. So how do you future-proof claims? So future-proofing, I guess, means shifting from reactive to being proactive. Getting systems in place, the documentation and invoices are collected at the right time, using detailed cost segregation reports to kind of break spend down into eligible categories, and always maintaining a clear audit trail. That way, your claims are going to be watertight, and if HMRC ever did query anything, you know that everything's going to be fine. And that's exactly where we come from. So where do we, as specialists, add value to clients? So again, like as I mentioned, we combine the knowledge of surveyors, valuers, tax experts to identify and quantify the allowances that general kind of tax teams don't have the time or tools to kind of dig into in more depth. So our role is to unlock hidden value, but also make sure that claims are fully compliant. And then we come along to kind of how we work. As I mentioned, all we do is capital allowance claims. We work with accountants, we work with solicitors, we work with many people within the kind of commercial property industry. And the key is that we work to complement you guys, not in competition. Because this is all we do, then we're not interested in looking at any kind of general accountancy business or providing any additional services to clients. We work with hundreds of accountancy firms across the UK, and we'll work with you and your client to obtain any of the kind of necessary information that we need. And the key thing again is surveying the building, identifying the items, and preparing the report. So again, but how do we do that? And what's the key to supporting you and your clients? So initially, we'll do a feasibility review. So we'll have a look very, very quickly at the property. We'll maybe look at the last couple of years' accounts, tax returns, the fixed asset register, and give you a rough idea as to whether we think a claim would be worthwhile proceeding with. Then we'll prepare, and with help of doing the survey, we'll also prepare the claim documentation and pull the reports together. Often claims will take 8 to 12 weeks roughly to fully complete, and we make sure we have everything really there to support anything that may be needed in the future if HMRC ever queried anything. To give you some context, as I mentioned before, we've done over 9,000 claims, and it's not an area where HMRC it's a fact-based claim. It's not a lot of R&D tax credit claims have kind of come under scrutiny recently. It's a lot easier with capital allowances. The item is either there or it isn't. So and if we can prove it was there, we've got the photographic evidence, we've got the values correct, then there's no issues. Out of 9,000 claims, we've had probably 6 claims that have ever been queried by HMRC, and from those six claims, we've gone back to them, we've answered the queries that they had, we've provided all the documentation, and they've gone away and said, "Yeah, okay, happy with that. We can see you know what you're doing." So it's reassuring in a way that it has been tested, but also again, I think because of the volume that we do, they like the way that we work, and they don't tend to look at these things in a lot of detail. Whereas if you've got a company that only does 1 or 2 a year and has a surveyor that's a mate that kind of pops in and does things for them, then things will come under a lot more scrutiny. So just thought I'd give you a few case studies really, just to give you an idea of kind of the kind of values and kind of what we would see. And it also gives you an idea, we're looking at here, with this example, there was an office purchase for £2 million. I've highlighted a few of the bits there that we'd be claiming for. They also have some office kitchens, carpets, flooring. It's one of these posh offices that has showers and toilet facilities, which we like, because we can claim for those. And then we've got lifts and lighting and all that kind of stuff that helps the office work. In this example, so the client said, okay, well, my accountant's already claimed capital allowances on the building, but the value seems a little bit low. So we said, look, if you don't mind, well, can we have a look at this in a bit more detail and see if we can add in any more value? We work on a success basis, so we charge a percentage of the capital allowances that we find and which are approved by HMRC. So there's no risk to the client. So yes, so we found the accountant had claimed for office furniture and equipment and so forth, but didn't have the invoices and receipts because they basically just acquired this property for those kind of embedded items in the building. So we did a review and we actually found an extra £280,000 worth of allowances from those kind of items within the property, which are difficult to identify without the use of a surveyor. So obviously, client's very happy, works very well. In the next example, excuse me, we had care homes. We had a care home that we were asked to look at, dealing with a seller that didn't complete the S198 election correctly. Unfortunately, we don't win them all. So with this one, the client said that, oh well, I haven't claimed any capital allowances, so I'm just going to put a £1 value down. Well, that wasn't queried. It just went through as normal. We were then asked to kind of review it post completion, and unfortunately, the client lost £400,000 worth of capital allowances, and they were a high rate taxpayer. So potentially that was £160,000 worth of tax benefits that they could have claimed. We did help them. They then went on further to build an extension, and we helped them kind of claim the capital allowances on that extension for that. I think they added some like 10 or 15 bedrooms onto the care home, but they were a little bit miffed, to say the least, that the S198 wasn't completed correctly. They missed out on the opportunity to claim additional allowances there, which could have been valuable in the cash flow of the business and saved them a lot of tax. So yes, there are instances there where we can't always win, and we were called in a bit too late to be able to give advice. And then the last case study was a hotel client. An accountant partner of ours referred the client to us. We worked together with the client and identified actually about £750,000 worth of capital allowances. Obviously, client was thrilled, loved the fact that their accountant was doing this for them, because everyone's looking for this kind of proactive approach and ways of saving money. And there wasn't a lot of additional work for the accountants. Like I said, we generally just ask for things like tax returns, last couple of years accounts, and a fixed asset register. The rest of it is a case of, okay, we'll go in there, we'll identify those items, and as simply as possible, we'll try and identify then those that what has and hasn't been claimed in the past. And it worked very well with this one. Claim went through in about 6 weeks. Everyone was very kind of motivated to get it pushed through, and generated some excellent benefits for the client. So it went well. So what are the key takeaways really from today's kind of presentation? So it's looking at, there are opportunities there which are missed every day. You can review the client's capital allowances at any point. If they own a commercial building, then we can look at these things. If they're going to spend money on improvements, again, we can look at that. If they're selling, if they're buying, again, the transactional side of things, we can look at that. Timing is key. Timing and correct kind of documentation, correctly completed documentation really does matter and can make the difference between a claim or no claim. And I do say this, but working with specialists can also add value and also reduce risk. We can deal with these types of things in the background without adding any additional work, but adding real value to your clients. So I've also thought I'd offer as well for any kind of attendees of today's presentation. We're quite happy to do a free kind of feasibility review. If you've got particular clients in mind where you think, oh, can we do something here? This is their situation. Quite happy to look at any kind of clients' potential claims and give you some kind of guidance as to whether we think there's a potential claim or not. My contact details are on there, so myself or a member of the team would be happy to review those for you. So that about wraps things up. Marie, have we got any questions which have come in which I can kind of help with?
Thanks, Andy. That was a really useful walkthrough of the world of capital allowances. I certainly took a lot from that. I am very conscious that we have strayed over our 10 o'clock deadline, and I can see that we have lost a few of our delegates who have headed off to their 10 a.m.s. So I have had some really interesting questions in for you. I think in the interest of time, I'm going to wrap up now. I'm going to pass those questions to you, if that's okay.
Yeah, no problem.
And obviously, you'll go back to those particular delegates with the responses shortly. In the meantime, I think there's only one thing left for me to say. I was going to tell you all about the really great sessions we've got coming up over the next couple of months. I'll just tell you about what we've got next week. So we are back next Friday. We've got a 3-hour session on a CPD session next week on accounting issues. And if you haven't had your invite, you'll be able to see it on the K3 Hub website. You'll be able to register from there as well. I'm sure that there'll be another invite going out at some point at the beginning of next week. So I think that's all from us then in that case. So thank you very much to you all for joining and for staying with us for an extra 5 minutes. And have a great weekend, everybody. Thank you very much.